Good morning, dear learners, and welcome you all to the next lecture of my course on financial literacy. This is module number 5, Cashless Banking, lecture number 24, an introduction to the Ponzi schemes and security and protection against the Ponzi schemes. In the previous lecture of this particular module, we had discussed the various digital payment schemes and the various ways with the help of which we can have an access to the online payment system that are offered by the banking companies and the financial intermediaries. In this particular lecture, we will be going to understand what are the different risks and uncertainties that are associated with the digital payment system and what securities and precautions must be taken by an investor or a consumer while thinking of the various investment avenues that he is considering for his prospective investment purposes. Every individual in their life has certain financial objective. They all want that their wealth and their revenue must grow with the passage of time. But in certain cases, the evaluation of all the investment avenues may be a failure for the investor because there may be multiple kind of scams as well as fraudulent activities that may become a threat to the investment opportunities that a consumer is having in front of them. So Ponzi scheme is one of the kind of financial scam, or you can say fraudulent activity with which you need to be aware of for the purpose of selecting the better avenues for your investment in the future. So let us understand the various things that we need to know about the Ponzi scheme. So in this lecture, I'll be going to cover an overview of Ponzi scheme and the key elements related with the Ponzi schemes. We'll also get to know how the Ponzi scheme actually works, as well as we'll be also going to take a case study of Pearls Agrotech Corporation Limited that was situated in the India, and it has also involved in such a similar kind of scheme which is known as the Ponzi scheme. We'll be going to be aware of the key red flags of any of the investment opportunity that may become in future a Ponzi scheme, as well as what securities and what precautions you can take against the online frauds and Ponzi schemes that will be also discussed in this lecture. So let us know a detailed meaning of the Ponzi schemes and let us understand its key element. So basically, a Ponzi scheme is a fraudulent kind of investment opportunity that promises their investor high amount of interest and revenue, as well as they also promise you that there will be no risk involved in the investment avenue. In such a case, the scheme operator promises the prospective investor that whatever money they will invest into the scheme, for that they will be going to earn more than 50% of the return, and also there will be no risk associated with the investment of their money. In this particular scheme, the scheme operator do not invest your money into any economic or productive activities. They only keep your money with them, and whenever you are going to attach one new investor with you, then the money that they get from the new investor is given to you as a return on your investment. So in such a case, no funds will be invested into the economic activities and no revenue will be generated, but the investors who have attached some new investors into the scheme, they will get return on the basis of investment done by the new investors attached by them. So in such cases, funds from the new investors are used to pay the returns to the earlier investors and hence it create an illusion that there are profitability and success in the investment wherever you are going to invest your money. So basically, it is a kind of fraud that lures the investors by promising them high returns with little, or you can say no amount of risk that will be involved in such kind of of investment schemes. It is not a legitimate investment. The operator uses the money from the new investors to pay the earlier investors, and no economic activities are undertaken under the Ponzi scheme. This particular scheme had been named after an Italian investor who is the Charles Ponzi, who had run such kind of scheme in the 1920s in the Italy, and he had created multiple kind of fraudulent investment opportunities for the investors in the particular era. The system eventually collapses, as whenever there will be no attachment of the new investors into the schemes, there will be no return to be given to the earlier investors. So whenever the new investment stops into the Ponzi scheme, the investment scheme will collapse and the existing investor will get no returns, as well as their principal will also not be returned to them by the scheme operator. So such kind of schemes may have these particular key elements, such as unrealistic high and guaranteed returns are promised by the scheme operator to the investor. Since it is not a legitimate investment opportunity, the earlier investors are given the investment funds that are procured from the newly attached investors into the scheme. So there will be no risk as promised by the scheme operator, as well as at initial stages they will give you higher rate of return on your investment money. Then they promise that there will be no or minimal risk that will be there in the investment scheme. So there will be claims of high returns without no risk. This will be a major red flag in case of any investment scenario to become it a Ponzi scheme in a future state. So there will be lack of transparency also. The operator will not give you any detailed or clear cut information related with the use of your fund, where they are investing your fund. This information will not be shared with you. Only the income will be shared with you. Whatever revenue they are getting, whatever funds they are getting from the new investor will be returned to you as your part of revenue. No financial regulatory authority will be registering such kind of investment scheme, and thus there will be lack of transparency also in such kind of schemes. Then they will focus on recruitment very heavily, because the whole of the schemes on the basis of which the Ponzi scheme works, it basically rely heavily on continuously recruiting the new investors into the scheme, and that is why if there will be no investor, the scheme will collapse, and that is why this particular scheme operator in such cases will always emphasize that existing investor should be going to attach more and more new investors, and they will be incentivized to bring new participant to keep the cycle of investment going. So these are the Ponzi schemes key elements. With the help of all these key elements, you can very easily make a distinction between the different investment avenues, that which one of them are safer to invest and which of the investment avenues may become a Ponzi scheme in the future. Now let us understand how there is a breakdown of a typical Ponzi scheme if we talk about. So basically the Ponzi scheme operator convinces at first stage the initial investor to invest their fund into the money. So there will be a single scheme operator who will convince the other prospective investor to invest their money into the scheme, and the initial investors will also be encouraged to recruit new investors by giving them multiple kind of incentives and benefits. So here the focus of the scheme operator will be to promote the new recruitment into the scheme. Then the schemer, when there will be new investors attached into the scheme, then the scheme operator will repay the earlier investor by using the funds that will be received by the new investor. So whatever amount of fund will be received by the new investor will be used to pay the earlier investors of the scheme. After that, the recruitment process will continue and more new investors will be recruited into the scheme, creating a larger pool of investors to keep the scheme afloat in the market. But after a significant point of time, when there will be no economic activity and no productive activities, with the help of all these pool of funds that will be arranged with the help of a lot of investors, then the revenue will start decreasing. When there will be no new investors who will attach to the scheme, then the scheme will collapse automatically. Now let us understand step by step how these kinds of Ponzi schemes work. So basically, any fraudster or any scheme operator of the Ponzi scheme promises a high and guaranteed return on investment to the investors, and due to the attractive proposal of theirs, the multiple prospective investors who are not very much aware of the financial market risk and uncertainties, they will be attracted towards such kind of schemes and they will invest their money, thinking it that the particular scheme is very profitable as well as safe to invest. After that, the early investors will pay money. The early investors who have already invested their fund, they will get the return on the basis of money received from the new investors, and this will create an illusion to the early investor that their money is being invested by the operator of the scheme and they are earning higher amount of revenue out of their investors. So in such cases, not actual investment will be made, but surplus and returns will be shared with the earlier investor to give them a state of illusion that their money is invested very properly into any economic activities. After that, positive word of mouth will spread automatically, attracting more and more new participants into the scheme. So the earlier investors who will get higher returns from the investment scheme, they will create a word of mouth of trust and belief into the scheme, and that will always attract the new investors into the scheme. So positive review through friends, family and social media will be going to attract more and more investors into the scheme, and hence the scheme will become afloat into the market. After that, the operator will avoid the actual investment, as we have discussed that in such kind of a scheme, the operator does not invest any fund into any economic or business activity, and the old fund which is received by the investor, that will be just cycled between the old and new investors for channel them for their personal use. So all the returns will be given by the new investors fund to the earlier investors, and in such a case there will be no actual return to be paid to the investors of the scheme. Whenever there will be a point where the recruitment will slow down or it will stop, in such cases the scheme will collapse. Once the recruitment will slow or stop due to suspicion or market awareness or any kind of legal action on the schemes, the operator will not be then capable of paying the promised return to their investor. In such cases, the scheme will collapse and many of the investors of the scheme will suffer with heavy financial losses. So this is how Ponzi scheme actually work. Now let us understand this particular kind of investment avenues with the help of a case study. So here we are going to talk about the Pearls Agrotech Corporation Limited scam. This has happened, which is having a total value of 49,100 crore rupees. So this was a very big scam that has happened in the history of Indian financial system. Over 5.5 crore investors were affected from this particular scams, who belong to mostly from the rural and the semi-urban India. So basically the focus of the operator of the scheme was towards those investors who are not very financially aware and financially literate, and that is why it was easy for them to attract them into the schemes by confusing them or by making a illusionary scenario of making higher profits with no risk. So the promoter of this particular scheme was Nirmal Singh Bhangu, a former Australian real estate agent, and he has been charged with the largest investment scam in our Indian history. So how this particular scam has worked: first, the operator of the scheme promised to be going to invest the money taken from the investor into the real estate business. So he had collected the fund from people on the basis of promising them that their money will be invested into the land development projects, and after that he promised that the land allotment will be made in return of the investment, and huge monetary returns will be given to the investor within a few years of time. He had recruited a large number of agents and sub agents and had offered them commissions as well as returns for their expanding outreach of the scheme. The targeted customers or the investors were vulnerable groups, that means those who are not having sufficient financial knowledge, financial literacy, as well as those who are also not having financial well-off status of living, standard of living. So those who are dreaming of having their own home, having a regular source of income, they were the focus of such kind of a scheme in case of the Pearl Agrotech Corporation Limited. The operations were basically, it was operated as an illegal collective investment scheme without the SEBI approval. So one of the very important organization or institution and act, that is the Security Exchange Board of India, who takes into consideration that the different schemes that are running on the financial market, the companies who are participating into the issuance of security and trading of security, they should follow all the rules and regulations that are laid down by the Government of India. Security Exchange Board of India takes care that they should follow all the regulation and comply with the various types of code of conduct that will always focus on the protection of investors' interest. So without the approval of SEBI, this illegal collective investment scheme was working, and instead of actually purchasing the land, PACL was only using the funds for paying the earlier investors. The fund that was taken from the new investor was used to pay the earlier investors, mimicking the classic Ponzi setup. So fake land documents were created, as well as massive trust structure were created, and official looking paperwork was done to avoid any kind of scrutiny, and allotment letters were sent to the investors of the scheme for the purpose of creating their illusion alive. So these were the basic operation of the PACL Limited for making their scheme work. Now, how the scheme collapsed: in the year 2014, SEBI declared this particular scheme as an illegal scheme and directed the PACL to repay their investor their money back. In 2016, CBI arrested Mr. Bhangu and senior executive of the PACL Limited after an intensive investigation, and SEBI also uncovered that the very little land was actually purchased by the PACL Limited for the purpose of investment. So despite of billions of money collected under the scheme, no or very minimum piece of land was actually purchased for the purpose of investment under this particular scheme. So basically this scheme was an illusionary scheme of investment that has promised the investor to give higher return without any risk. After that, the aftermath and recovery process of this particular scheme, in the recovery process of this particular scheme, SEBI has formed a committee that was led by Justice R.M. Lodha sir, tried to manage the funds of the investor for the purpose of their asset recovery. So basically all the properties of the PACL Limited was attached and auctioned for the purpose of recovering the money out of their property and paying back the investors of the scheme, but the process was very slow and it is still ongoing, and millions of small investors till now also not have received their full amount of investment in this particular scheme. So especially those with minor amounts have suffered a lot due to the particular scheme, and this particular recovery and aftermath has also exposed serious regulatory gaps in CIS registration, agent monitoring and investor protection. So the government of India along with the SEBI now made some amendments in the various regulation that needs to be followed by the different investors of the market as well as different market participant for creating any kind of investment scheme. The key takeaways from this particular case study may be discussed as it demonstrates how the lack of financial awareness as well as weak regulatory enforcement can lead to the mass scale fraud in any country. So even in such kind of big country where large number of investors are there, if you will not educate and the investor will not make them enough financially literate and aware about the various practices that are going into the financial market, then this kind of schemes will happen for sure. This particular case highlights that there will be a stronger need of due diligence as well as public education should be promoted, and faster recovery mechanism should be made by the government of India and the SEBI for returning the money of the small investors into such kind of fraudulent schemes. So this is one of the very clearest example of how the Ponzi scheme can hide behind the facade of the legitimate business in the India. So this was a great example in the case of Indian history of the fraudulent schemes that has happened before, and with this you must need to understand that how you should identify any fraudulent financial schemes and avoid your investment, your fund to be invested into such kind of scheme. Now let us understand how you can identify that the particular investment avenue is a Ponzi scheme. For that there are certain key red flags that you can very easily identify. The first one is it offers you some unrealistic returns. So if in the market, suppose that average rate of return of 10 to 12% of the return in any particular investment avenue, then these kind of Ponzi scheme will always offer you more percentage of return as compared to the average rate of return in the market. So they may offer you to double your money into 6 months, or any kind of high return promises can be made with the investors that will be exceeding the actual market averages rate of return. There will be no risk claims. That means there will be some statements like the investment avenues are 100% safe, guaranteed returns will be there, and there will be a zero amount of risk in such kind of scheme. So this should be always kept in mind that investments are always subject to risk and uncertainties, and it is not possible that higher amount of returns can be given to you without any amount of risk. Then it will have a opaque business model. That means vague and complex and confusing explanations about the investment of your fund will be done by the side of the scheme operator. So how the business is going to generate the profit on this particular aspect, no clear information will be shared with you. Then all the operations will be unregistered. The scheme will not be registered with the regulatory authorities such as SEBI, RBI or MCA, which is a legal requirement for the investment companies, and this will always focus on high amount of recruitment. So heavy emphasis will be made on attaching the new investors into the scheme, and rewards will be given to the existing investors for bringing in new investors into the pyramid like structure. Then no real profits will be generated. You will be given returns for a certain period of time, but no actual surplus will be generated with the actual investment into any kind of productive activities. So actual business activity will be not there and asset growth will not be there, but they will give you money with the help of the funds collected by the new investors of the Ponzi scheme. So these are the various key red flags with the help of which you can very easily identify that a particular investment avenue is not safe for you and you should avoid your funds to invest in such kind of funds. Now let us understand what security and precautions must be taken by a consumer against the Ponzi schemes and the online frauds that are happening nowadays. So with the advent into the ICT tools as well as the digital payment system, nowadays many often we listen that there are scams and fraudulent activities that has been occurred with the consumer in the online digital payment mode. So how we can prevent these types of scams and fraudulent activities? We first need to verify before investing. That means we should first do some kind of research and analysis. We should know about the company's background, the founders of the company, what investment model they are adopting. These different informations must be collected by you before investing your money into the investment avenue. As well as you should also have a check on from which of the authority the scheme or the investment company is registered, such as SEBI, Security Exchange Board of India, RBI, then Association of Mutual Fund of India is there, IRDAI is there, Insurance Regulatory Development Authority of India. These different authority make code of conduct or regulation for the investment companies and the corporate world, so that they should follow all the rules that will protect the interest of the investors. So if they are registered with all these different authorities, they will be surely going to follow a standard code of conduct, and the scheme may be having a very clear cut investment model that will give you actual returns or profit. Now cross check claims will be also done. That means you don't should rely on the testimonial as well as promotional content or any kind of celebrity endorsement that is done by any investment scheme. So you should always cross check whatever promises that they are making in their advertisement. The claims that they have made, they should be cross checked before investing into the schemes. The next step for securing yourself from such kind of a scheme is to identify red flags. So we have talked about the red flags of the Ponzi scheme, that unrealistic return will be there, lack of transparency, pressure tactics will be there, such as limited time offer, as well as invest your money or you will miss the opportunity. Such kind of pressure tactics will be used. They will always focus on recruiting more and more investors into the scheme, and social media hype will also be created by viral promotions or any other kind of advertising without taking into consideration the regularity compliances of the various authorities that make different kind of rules and regulation. So they will mislead the prospective investors with the help of all the content that will be shared on the social media platform for the advertising of the scheme. So you can identify the schemes with the help of all these red flags. Then you should protect yourself from phishing attacks. Phishing is one of the most common ways of a scammer to gain access to your account. So don't click on any kind of suspicious email, any link or messages sent on your social media apps that pretend to be from your bank or any market brokers. So you should avoid any unknown link, any suspicious email or messages that you receive on your mobile phone, on your laptop, in your emails. So you should not click such kind of links and suspicious emails so as to keep your money secure with them. Never share your OTPs, password or pins with any other person. So legitimate institution will never be going to ask about the OTPs or password or any kind of pin from you. So you should keep it very secure with yourself only. And You should check the website before you are using secure HTTPs and not a fake clone. As well as you need to also stay cautious in the digital world. Always you need to follow the two-factor authentication process for using all your bank account and financial account. Keep your laptop and electronic gadget software with the antivirus updated. Avoid using public Wi-Fi for your financial transaction, as well as monitor your accounts regularly for identifying any unauthorized activity. So next step of keeping yourself safe with such kind of Ponzi schemes, you should watch out for emotional based investment scams. That means there is a growing trend in the market that involves scammers who are going to build emotional relationship online and eventually guiding victims into fake crypto trading platforms, fraudulent forex and stock trading apps, as well as they will promise the fake opportunities of investment to guide them, helping their partner to get rich together. So if such kind of emotional based investment scams are promised to you and new relationship is being built with you suddenly, then and it involves any kind of investment advice, it may be a major red flag for the investment schemes. Next is to beware of the cryptocurrency Ponzi scheme. Crypto based Ponzi scheme often use some buzzwords like blockchain, AI bot or daily passive income as a key sign. So these should be avoided by the consumer. Guaranteed return with no risk, such kind of lines will be used. Unregistered platforms without following any regulations will be there. If such kind of red flags are identified in any investment schemes and without any legit crypto investments, there will be some volatile and unguaranteed returns, then the research should be made by the consumer before investing in such kind of scheme. So all these red flags should be identified before investing into the cryptocurrency Ponzi scheme. As well as you also need to report and stay yourself updated. So if you find out or identify any of such kind of schemes, you must call on 1930, which is the number for National Cybercrime Helpline. As well as you can also file a complaint on the website of cybercrime.gov.in. So here you can lodge a complaint of such kind of investment schemes. Those are identified by you as a fraudulent scheme. The report of the financial frauds can also be made with the SEBI scores portal by giving your information at the https://scores.gov.in. As well as you should also follow the updates given by the SEBI, RBI and cyber security cells of the country. So these may be the various steps with the help of which you can keep your money secure and you can avoid any financial scams and fraudulent investment opportunities from your life. So while financial scams are becoming more and more sophisticated, you need to keep yourself more and more aware about the financial market. You should be well informed that what are the different types of identifications are there, key elements are there that may be present in a fraudulent investment scheme, and you need to keep yourself updated. You need to verify the sources of the schemes, as well as you always need to be skeptical of too good to be true opportunities, and this will be going to protect your money and it will be going to also help you in having a safe financial future. So with this, I conclude the today's lecture. Thank you.